All right, Big Bang, today is Thursday. It's December 12th. Welcome to the Dog Walk presented by Barstool Sports. Today I'm joined in studio by David Hochberg. David is a residential mortgage lender from Homeside Financial. He did my loan. He did Chief's loan. He did Dave's loan. He's helped us out a lot. And since our audience is ever so growing and we're getting older, a lot of you guys have been sticking with us since, 2018. Yeah. I thought it might be a good idea to have Dave pop on here, answer some questions, and just kind of talk shop about mortgages.
Yeah, no, thanks for having me. But we saw that video that Dana did. I can't think of the other guy's name right
Francis,
now.
Yeah.
Francis, and I'm like, okay, these guys are talking. They are not giving out any, valuable information, just talking about buying a home. So I forwarded it over and said, hey, why don't we dive a little deeper? And here we are.
Yeah, no, it's great because you, the process, you go in head first.
Yeah.
Right? There's no, you made it easier for us, obviously. But
how many times do you buy a home in your lifetime?
Yeah.
Right? I mean, I do it every day. Right?
Yeah, for sure.
I mean, I was just talking to a 28-year-old couple down in Missouri buying their first home, right? They called me last night at 8 after shopping around, like, okay, we agreed on a price. Can we get it done by the 8th of January? I'm like, yeah, it's under 28 days. Yeah, 30 days. No, it's no problem. So they're freaking out, and I'm just like, all right, pop the Ambien, switch to decaf, do your breathing exercises. We'll get you through it.
Hey, before we really get going here with my friend and mortgage lender, Dave Hochberg, I want to talk about Portillo's. Sprinkle in the holiday spirit. The Candy Cane Shake is back. Order yours now. Embrace the winter with a Candy Cane Shake. Order now for a limited time. If you are seeing this, it's meant to be. Get your Candy Cane Shake now. We promise it's as good as it looks. Get your Candy Cane Shake today. We will be in Minnesota in a tailgate lot with a copious amount of Portillo's this Monday. So if you're in Minnesota and you want Portillo's, you want to hang out, you want to talk some football, stop by. We will have the details on our social media accounts, and I'm going to make sure that we get some of these Candy Cane Shakes because I want to try it. I want to give a live review. So order Portillo's today. You can't go wrong with anything on their menu. That's the best part of Portillo's. You can throw a dart and everything's good. So go check that out, whether you get the burger or the beef, the hot dog. It doesn't matter. Just make sure you're getting Portillo's. And I hope to see you guys out there on Monday. It's going to be a fun time. Besides the whole game part of it. So.
Yeah, besides the inevitable final outcome.
Yeah, exactly.
Other than the football.
Yes, exactly. But for the Portillo's and the people, Minnesota nice. I'm excited to hang out. And we'll see you there. Come meet some Portillo's. Be a good time. And so I think a lot of people, or at least myself early on, don't even know the distinction between just your realtor and their mortgage person.
Where do you start?
Yeah, right?
Right.
So that's where if you can get into that, if I'm like, hey, I want to, I'm thinking about buying a home. I think tomorrow's going to be the day, Friday, December 13th. What would you recommend? Where do you start?
Well, the first thing you start is you have to talk with the lender, right? Because a realtor is not going to speak with you unless you've spoken with the lender to get pre-approved. Because the realtor is not going to want to schlep you around with gas at $3.50 a gallon and driving you around in the cold to see if you could buy a home if you haven't spoken with the lender to pre-qualify for a mortgage, right? So once you overcome that, the first step really is, are you ready mentally to buy a home? Okay, I mean, that's step number one. And there's nothing wrong with renting until you're ready. That's why we have apartments, right? That's why 35% of Americans or 37% of Americans rent. There's nothing wrong with renting or living in your parents' basement until you're ready to go out on your own. So that's the first step, right? You got to have that conversation with yourself and with your partner. Are you ready to go? Once you make that choice, then you've got to talk with a professional lender who will then walk you through and did what we did with Chief and you and White Sox Dave. How much you got for a down payment? How's your credit? How much do you have for an emergency fund? When do you want to pull this off? When is your lease over, right? And then we just start walking through the process.
Mm-hmm. How many people would you say, out of the gate, where you're like, hey, sorry, we're just not, you're not there yet? Well, I think that probably stops a lot of people, right?
Yeah, well, the conversation when you start breaking down, okay, how much money do you make? All right, let's just use $120,000 a year because it's easy to do the math. It's $10,000 a month. Mm-hmm. Okay, so 45%, right? And this is where Dana and the other guy didn't cover with this, right? So you got to take your income divided by 12, and you got to take your gross income. So if you're making $120,000 a year, I know not everybody's making $120,000 a year, but it's $10,000 a month. It's easy to go over. You've got, you qualify for the housing payment and all your debt, 45% of your gross income. Okay, and we'll put up a chart. I've got the numbers right here. So I'm just going to give ballpark, right? Most of your listeners have got a car loan or a car lease. There's $500. Most of your listeners have some type of credit card debt, right? If you have $25,000 with credit card debt, which is pretty much where the average is right now, that's $750 a month, minimum monthly payments. If you have student loans, right, another $500 a month. So when you start layering these things off, it reduces the amount of money that you qualify for. So everybody's like, I want to buy a $350,000 home. Great. Okay, let's back into it. Let's first go over all your debt, how much money you make, then go over your debt, subtract all that, and then here's what you could afford. And then once they start seeing those numbers, they're like, hey, I'm ready. I'm good. Or you know what? I need to pay off some more debt. I need to pay off that car. I need to pay off some of those SoFi, Best Egg, market lending, Lending Tree Club, all of those type of high interest rate short-term loans. They have to pay those off in order to qualify. And then we just have the conversation. The consultation's free, Eddie, right? That's the biggest thing. When you call a lender that you want to work with, just like we did with you three guys, we walked you through the entire process. And here's the deal. Okay, you're not ready now. You're ready in 6 months. Here's what you got to do.
Now, do you get dinged on that though? I think a lot of people are worried about getting dinged, like kind of like a full on a credit report and shit.
Yeah, we got a couple of great questions from your viewers and listeners about that. We could do a soft pull on our buyers' credit scores, so it doesn't show up as an inquiry. So I don't know how exactly it works on the backside, but we do a soft pull on one of the credit agencies. Use that information. There's TransUnion, Equifax, Experian. We rip one of them. Use that information and assume that the other two agencies are going to be similar and build a profile off of that. If you would like to go hard and do a hard pull, then we just do all three and then just, you do the full colonoscopy, if you will, and see what's under there. That's what I like doing. If you're serious about buying a home, we'll invest the money in the credit report fee. We're not going to charge you for a fee.
Yeah.
We'll rip the fee out and, we'll eat the fee. We'll do all three. And then, hey, here's your CAT scan, right? This is what we got to work on. This is where your challenges are. Or, hey, you're perfect health. You've got no debt, ready to go. This couple down in St. Louis, 28 years old, combined income, $140,000, right? All in the wheelhouse, no debt, as plain Jane and vanilla as you want to be. He's 780, she's 740 credit scores. Poop through a goose, right? 20% down. We got a property inspection waiver. We didn't even need an appraisal, and we're closing in under 30 days.
Boom.
Boom.
In and out.
Right. Now they're freaking out, right? I said, I know you're excited and nauseous, but this isn't our first rodeo, and we're going to get you through this. So just stay seated with the seatbelt fastened and your arms in the car and wait till it comes to a complete stop. Just get us all the information. We'll get you done.
All right. So that's good to know, I think, for people, because
it's overwhelming.
But I think that is a hesitancy. People be like, oh, they're going to pull my credit, and then what if it's not fine? Then it's going to hurt me, and then I'm going to not be ready. And
right.
So you're just in general, if you be like, hey, I just want to see where I'm at.
Yeah.
Here's what I'm spending out. Here's what I'm bringing in.
Consultations free.
Yeah. And then like everything, they'll tell you could tell them what they owe and everything like that.
100%.
So then you give them that. I guess one of the questions here too was from Mikey. What are some of the tips you can help first-time buyers or people looking to buy in the next 5 to 10 years? So do you have like top 3 tips or something like that?
Take your debit card, shove it right up your ass. Stop using your debit card. It's the worst type of investment that you can make. You're not building any type of debt. You're not building any type of credit history off your debit card. The debit card is the biggest sucker's bet out there. So you have to get off the debit card. The challenge with a lot of the buyers in your generation, right? I'm 57 years old here, right? A lot of the younger generation, I got 3 girls, they're the same way. Debit card drives me crazy. So stop using your debit card because you're not getting any credit. You're not strengthening your credit profile.
So even like your $5 coffee.
I went to the McDonald's in Ogden and Lake, okay? I had to burn an hour and a half, with the traffic and everything, so I had a coffee there. Boom, put it on my American Express. I charge everything.
Okay.
Right? Load up gas, boom. Right? I go out for a sandwich with somebody, $15-$20, boom. Everything goes on a credit card. Now, if you don't have any credit, okay, what you have to do is I could help you establish your credit if you went through a bankruptcy. I just talked to a kid, they're my daughter's age, right? He had a gambling challenge, right? He was on a good streak, and then he had a bad streak, and now he's got $25,000 on his credit cards, and he thinks he's going to lose his house. I'm like, dude, you're not going to lose your house. Call a bankruptcy attorney. I made the recommendation. a referral, and I'm like, listen, file bankruptcy. I'll help you start rebuilding your credit with a couple of secured credit cards. So if your listeners and viewers have challenges with credit, I can help them establish credit absolutely free. I'm not going to make any money on this. It's just building the relationship. We have a Team Hochberg secured credit card with a local credit union. Give them $500 cash. You're gonna burn through $500 a month just to survive. Use the credit card instead, build up your credit so you get stronger there. So that's another thing. First thing is stop using your debit card. Second thing is start using your credit card. Third thing is if you don't have any credit and you want to build your credit other than the secured credit card, get added as an authorized user to a family member's card that trusts you. And then what happens is you sidecar all of their credit history and you get the benefit of their credit. So those are the three best things that I could recommend. And then the fourth is if you don't need it, don't buy it and just save as much money as you can. I always joke, pasta, water, and apples, right? If you want to buy a home, start saving your rear end off and start building your emergency fund, start building for a down payment and closing costs. So that's the best recommendation I could give for any of your viewers and listeners who are interested in purchasing or refinancing in the next 12 to 18 months.
Is there like a number to shoot for just based on like the median house?
Yeah, if they've got right now, without diving too deep into the weeds, if you're a first-time home buyer and your average median income is below the area's average median income, I believe Cook County in Chicago right now, we're like $129,000. Okay, so down in St. Louis, I think it was like $103,000 in the area that the 28-year-old couple was buying. So if you're buying a home and you're a first-time home buyer, which the definition is you haven't been on a title of a home in the past 3 years. So if you got blown out of a home a couple, 3, 5, 6 years ago, and you're getting back in the market and you haven't owned a home in the past 3 years, you're now considered a first-time home buyer, according to the federal government. Doesn't make any sense, but that's the rules, all right? So if you fall under that, your credit really isn't that big of a deal because you get all of the adjustments waived. Now, if you make more than that, you obviously want to get as high of a credit score as possible because your interest rate will be reflected upon your credit score and the amount of the down payment you're putting down. So a lot of moving pieces.
Okay, definitely.
And it's always better to go through life with better credit than bad credit because then everything is less expensive in the future, like a car loan, a car lease, any type of financing you want to get.
The right time. I'm sure that's like one of the things you hear the most.
Sure.
Especially based off interest rates.
Right. Which we have no idea where they're going. But they've been up and down like a yo-yo.
Is that like hell for you, knowing like you can't truly tell someone what the right time is?
Well, it really sucked in January of 2023 because we had a 2-year run of rates in the 2s and the 3s. And January 23 rolls around, and we started out at 3.5. And by the time we got to July and August, we were in the 7s.
Yep.
Okay.
Guess where your boy fell on that, listeners.
Right. But then we cycled back as soon as they dropped. We called you and said, hey, rates are down. Let's do it. We covered all your closing costs and got you out of the PMI and saved you, I think, $200-300 a month and didn't cost you anything.
Now, is a closing cost required by the state, or is that just like a fee that mortgage lenders have?
Yeah. Well, you've got our processing costs. Any reputable lender is going to be around $1,495 for all their costs. You got title fees, state depending. Here in Illinois, on your size loan was about $400 to $500. Down in Florida, it's more expensive, and each state is different how their title is because Florida doesn't have an income tax, so they drill you on every type of transaction fee that you have. And like on your size loan down in Florida, we just quoted a guy yesterday. It was like $7,500 because his title insurance was over $4,000 on his size loan, which elevated the costs of refinancing.
Huh.
So it's great that you live in Florida, right? You have warm weather, you have low taxes, and you have hurricanes. But here we have higher taxes, blizzards, crappy weather for 4 months, but we have lower closing costs. So there's a trade-off. You just got to check which state you're in.
Okay.
It all depends.
We can go through some of these too.
Fire away.
Unless if there is like a base you wanted to start with more. I think like the tip question was kind of like a good primer, but
yeah.
Is there anything else you wanted to get into before?
No, I just think that, again, you have to be mentally ready to own a house. And there's nothing wrong if you're not ready today. Let's create a plan to get you ready tomorrow or 6 months or 9 months or 12 months down the road, right? And I think one of the best questions was, what do I do? How do I find a good lender? I think that's one of the questions we got coming up that I wrote down from all of the responses on Twitter. How do you find a good lender? Well, ask around, right? Check out Google reviews. That's a great way. We have over 500 5-star Google reviews. And check out who your friends bought their home with. What was the experience? How was the realtor? Did you enjoy your experience? You're going to be working with those professionals for 30, 45, 60 days. And this is the biggest investment a lot of your viewers are going to be making.
Yeah.
And you better be aware and you better be comfortable with who you're working with. And you better have an idea and a comfort level that they know what they're doing. And if a challenge comes that was unexpected, that lender and that realtor could get over it.
Okay, the first one's from Seth here. How do you shop around for mortgage rates? Will this not affect your credit score? And would the answers to above be the same for refinancing? Are the mortgage rates offers you receive in the mail / calls legit, or are they kind of a scam? When is a good time to refinance?
Yeah, I had that written down as well. That's a great question, Seth. So the stuff that you get in the mail has to be printed off, has to be mailed. Right? So all of those rates change every single day. They're based upon the 10-year bond right now. Okay. So the rates got a little worse today before I got here. So they opened up at like 10 o'clock, 11 o'clock Eastern time, and they are constantly trading. So if you're getting something in the mail, it's spoiled milk. It's ridiculous. If you get calls from somebody that you don't know to refinance, what are you doing? Right? I mean, this is, again, the biggest investment, hundreds of thousands of dollars that you're investing in. You're talking to some putz on a phone call that you have no relationship with, that you don't know what's going on, that most likely is going to drill you with unexpected closing costs that you're not going to know what they are, because how many times do you refinance in your lifetime?
Yeah, that was kind of an interesting factor that I didn't really know about. Like you said, because I went with you and you helped me through everything. I didn't realize that I'd be solicited from all these other companies that want to take on the loan and want to do all this work. So is that kind of just like the dirty game, or that's just a game, or how does that work?
Here's the challenge. It's a great question. So do not call.gov. Okay. So you're not on the do not call list. So when we pull your credit, these bastards at the credit agencies, Equifax, Experian, and TransUnion, they sell your information to other lenders. Okay. It's called trigger leads. They sell your information, and then you get blown up like crazy from other lenders trying to call you because, I don't know, there's a special code when mortgage professionals pull your credit. So then for some reason, it's legal for TransUnion, Equifax, and Experian to take your information, sell it to another lender to call you. I mean, there's a bill going through Congress right now, but if you don't want that to happen, go to do not call, I think it's do not call.gov, and register for that, and then that'll take you out of the loop altogether.
Yeah, it's honestly crazy because, and then not even that, you have your site that you make your payments on, but then you'll get their LLC mail, and it's a lot of confusion.
Well, after the closing, okay. Yeah. So Ramblin' Ray, he's a radio morning host here on WLS, right? I go on the show every Thursday. I closed his loan about a month ago. He started getting stuff in the mail, so solicitations with our name on it. So he sends me a text with this. I'm like, just send me everything. So I call. What they do is the county, after your mortgage is recorded, because it's a legal document, they have to record it at the recorder's office. It's free game for every swinging dick out there, marketing company, to rip your information off the public records and sell it to somebody else. This was insurance in case he died, that his mortgage would be paid for. So it wasn't even our company, even though it had, Ray, his address, lower, our company, Homebuyers, lower with the loan number and all that. It looked official. He's like, what are you sending me this stuff? I'm like, dude, we're not sending you this stuff.
That's fucking nuts. So you could do that.
It's legal. It shouldn't be legal. I've been doing this 24 years, Eddie. August was 24 years. I've seen this ridiculous bullshit for the past 24 years. And I don't understand how you could take another company's information and put it on your letter and then send it out as if you're representing us, but on the bottom of the sheet, it says we're not affiliated with Homeside Lower in any way, shape, or form, and it's a different NMLS number, National Mortgage Listing Service, a licensing service number. It's a joke. So, we just tell our borrowers, you're going to get a bunch of crap. We're not going to send it to you. If you have any questions, call us, and we'll sort it through.
Yeah, that's one of the confusing, most overwhelming parts for sure.
Yeah.
Besides,
just get bombarded.
Yeah, it's crazy.
It's
crazy, and you don't know what makes sense and what doesn't.
Right.
So was there anything else that we didn't touch on from his question, or should we?
No, it was a pretty well. He asked. I think part of his question was, what about opening up new debt, like getting a car loan, Okay, it's a great question. Last thing you want to do prior to buying a home or refinancing a home is make any large purchases. Okay, the reason is you're taking on new debt. You're going to have that company run your credit. You're going to now have a new payment on a fully paid off, a fully loaded up loan on your credit report. It's going to sink your credit scores. So the best thing you could do is this. If your car is a piece of crap and it's breaking down and you need a car, then you need a car. If you've got a lease and it's coming up and you're ending in February and you want to close on a home in April, best thing to do is to go to that car company, the car leasing company, and say, hey, I want to extend that lease out another 6 months. I want to extend that lease out another 5 months. Get you over the closing of the date that you purchase your home. And then don't pull credit. Don't shop for a car. Don't do anything until you get the keys in your hand. Perfect example. Buddy of mine up in Northbrook where I live just closed his home Monday. We got the clear to close. We blasted it through. We got it done like 2 weeks. We got the clear to close, and we set up the closing last Wednesday for yesterday. So he thinks in his head, loan's done. He goes out Saturday, buys a car. So all lenders have to pull borrowers' credit one last time before they close on their loan to make sure they haven't taken on any additional debt. This guy thinks his loan's done. Your loan's not done until your loan funds. His loan funds on Thursday. He went out, bought a car. He got into a T-bone. So his car was totaled, and he's been putting the car purchase. He's fine, a little shaken up, a little sore, but thank God he's okay. He's been putting this purchase off until after the refinance. So he thinks that since he's closing on Monday, he's done. No. So he goes out on Saturday, throws on a $571 car payment, which was fine because he had plenty of room in his income. We had to verify the loan. Loan will fund on Thursday. Fine. I called him up last night. I'm like, dude, what are you doing? He's like, I just assumed the loan was done. I'm like, well, don't assume anything. You got to wait until the loan funds, which is Thursday. So another tip, don't make any large purchases. Don't apply for anything. Don't close any credit cards down because that'll screw up your credit if you lose availability. Keep everything the same. Like a lot of people want to go to Apt, right? The large electronics store here in Niles, Morton Grove over there to load up on all their good stuff. No, on the way home from the closing, go to Apt after you get your keys, and you can do whatever you want after you get your keys. From pulling your credit until your loan funds and you get the keys, don't do anything.
So how far along needs to go by before they could hit you up? So say if someone just bought a car in, November.
Yeah.
Like, should they wait until like April to talk to you?
Well, if their lease is up or their car, or if they get into a T-bone like my buddy did, right? He wasn't anticipating getting into a T-bone.
Yeah.
We just refinanced and we saved him $2,000 on his mortgage, right? He was like some adjustable rate mortgage in the 8, so we got him down, saved him a ton of money. He needed to refinance and we were fine. So try to time it until after. But again, if you get into a car accident and you need a loan or your car breaks down and you need it for work, we'll just work around it and know that it might impact your credit score, and it is what it is, right? That's life.
So it's kind of a case-by-case basis.
Case-by-case basis.
Yeah, all right. So there's not like a finite amount of time that needs to go by
before
you could qualify here.
And the good thing with this guy is the lower the loan to value, right? So he had a $490,000 mortgage. He lived in a $1.1 million home. So his loan to value was under 50%, right? So if your loan to value is under 60% and he had 700 credit scores, it wasn't that big of a deal for him. So it didn't impact him at all. But again, knowing that if you need a car and you take on a big debt, it's going to probably negatively impact your rate a little bit. I mean, your credit score, might impact your rate, but it is what it is, right? You can't stop life from happening.
And that's just kind of the unfortunate part. Even if you can't afford it, it doesn't matter. Someone's about to give you a big chunk of change. They don't want you to be messing around with other loans and other money, right?
Well, you don't want to take on new debt, which might probably lower your credit score. And then that monthly payment associated with that debt might disqualify you from purchasing a home or refinancing a home because that new debt might bounce you out of qualification reasons. Mm-hmm. Right? So his payment was $571. Guy makes a couple hundred G's a year. He was fine. He had a lot of room there, and we were able to get it done without a problem.
Okay.
Yeah.
Next one's from Sam. I bought my townhouse in 2021 at the age of 25 in Colorado by myself. I'm contemplating selling it this year depending on the economy, but a lot of people have been telling me to rent it out / Airbnb it and move into an apartment until I'm ready to buy another home. Thoughts?
Okay. Thoughts are smart that you bought in Colorado, one of the hottest markets in the United States. It's been astronomically, exponentially blowing up, especially through COVID. Everybody was moving out there. So congratulations to Sam. So 2 parts on that. Why move out of your house when you're not ready to move out of your home, right? So I would stay in your home until you're ready to either sell it or rent it out, right? I mean, if you could Airbnb it, you got moving costs, you got all of these different, you got the headache and all the bullshit of moving all your stuff out. So Sam, I would stay in, I saw that question come through. I would stay in the house until you know what you're going to do, where you're going to go, right? Do you want to rent it out or Airbnb it? That's a great question, right? Sam's probably made a ton of money in equity just in the past. He bought it in 01, right? So he's got a good 4-year run on it, 3-4 year run on it. 21. So, I mean, he bought in 21. We're at the end of 24 right now. So he's probably got a ton of equity tied up there. Does Sam need the equity to put down on a new place? Has Sam ever managed an Airbnb before or a rental property? Does he want to go through that mishigas and have to be responsible for all that? Or does Sam just want to sell it, pocket the dough, and put it down on his new place, right? Why move out of a place and into a rental when he's living comfortably in his current home? So a lot of different variables. It's tough to give you a specific answer because I don't know what Sam's situation is, right? I mean, does Sam want to become a landlord? I mean, does Sam want to become a management company for an Airbnb? Nothing wrong with that, but Sam has to be ready to take on that responsibility. If he's not, maybe hire a management company or an Airbnb company to manage it and then move out.
Is it easier or harder to get that second loan? Because, I mean, I assume just based on the credit, it might be easier, but I could assume because, there's too much debt there.
No, it depends. If you have a rental contract come in to offset that debt, right? The Airbnb is a different story, Eddie, because you don't have a track record of the Airbnb dough coming in. You typically need 12 months of that to show it on your tax returns. If Sam it wants to Airbnb it out, great. The money's coming in is covering his mortgage nut, great. And he's making a couple of bucks on the side, great. And he wants to rent and he's stockpiling all this cash, great, okay? And he has no intentions of buying any time in the future and he can make a ton of money renting out his place. That's more than what he's currently renting a new place. Yeah, fine. And he hires a Airbnb management company to do it, great. If Sam is going, like here, I lived in downtown Chicago, right? 2800 Lakeshore Drive. I moved to the burbs. I needed the equity in my condo for the down payment on my home, a single family home in the suburbs. So as much as I could have made renting it out with the great rate that I had to sell it, take the equity to buy someplace else. So it depends, right? Yeah. Each situation. Sam wants to talk about it more. He could give me a call offline. I'll be more than happy to run him through the different numbers and different situations that he might have thought about or might not have thought about.
But okay, that's good to know that they will look at you having income from renting it versus like, hey, I just want a second home.
Right.
Then that's a whole different beast.
If it's an investment property,
yeah,
you have to show the lease, got to show all of these different things. So then we could count it. If it's an Airbnb, we have to wait a full 12 months in order to show that that's a viable business. And
then you're kind of in a tough spot then. You got to figure out a spot to live for a little bit because you need to show proof that it works, not just you're going to take out 2 mortgages.
Here's the other thing Sam and others might not have thought about. Oh, it's real easy to be, a landlord. Your insurance is going up because it's no longer your primary residence, and your real estate taxes are going to go up because it's no longer your primary residence. All right. So you factor those 2 things into when you start quoting out for a renter to come in, and you got to offset those 2 costs. That's why we got to dive a little deeper. It's tough to answer it in 15 seconds here. Yeah.
This one's pretty good. I just bought a home for $365,000. I had $360,000 cash, and I had an 802 credit score, and got denied a loan because I don't make enough money at my job. How does this make any sense?
Yeah, I saw that one as well. So, okay. So definition is I don't make enough money. I don't make enough money to buy a home, even though I've got all that cash. So again, we don't know what that person's debt load is, right? We don't know what the income is. I get this all the time. Well, I'm making the current payment on my loan at 8%. How come I can't qualify for a 6.5% refinance? Well, you're not showing any income. Right. And if you're not showing any income, it doesn't matter. You still got to show that you could cover the taxes, insurance, any association fees, and you got to cover the mortgage payment. So what you have to do is, even though you've got all this money in the bank, I don't know that guy's situation. You still have to document your income, Eddie. right? If you're a W-2 employee, we need a W-2 and 2 pay stubs. It's really that simple. If this person is not making enough money to cover the taxes and the insurance and whatever mortgage payment it is and has a ton of debt, might not qualify. If this person's got a boat and an RV and the boat's $1,600 a month and the RV is $3,200 a month, okay, we got to cover close to the $4,000 or $5,000 worth of debt there to offset his mortgage payment. So there's a lot of variables. I saw that, and there's just way too many other variables that go into. I'm glad that that person had enough money to pay for cash. Maybe after a call, I could help him pull some money out with a refinance. It's called delayed financing, where you pay cash for something. We're seeing a lot of that, where the parents are coming in paying cash for the house because the buyers don't have the dough, and then they pull the money out of the house when they can afford it to pay the parents back. So there's a lot of different variations of what's going on, and it's tough. I don't know the exact situation. There are a lot of variables going to getting a loan, as you know.
Yeah.
And it's tough to answer that type of macro question without having all the micro question without having all the macro information.
Deferred financing is interesting.
It's a huge benefit because
how long has that been going on? Is that like a new thing or no?
It's been here for a long time, but it became in vogue during COVID when there were 12 to 15, 30 people outside the door. And if you didn't have a cash offer, you were getting bounced. So a lot of listeners were having trouble getting financing, getting their offer even sniffed at because the houses were going so quick because of the low interest rates. So,
now, was that because people are actually buying, or was that more the BlackRock Zillow thing?
No, that was because people were buying.
Okay.
BlackRock's not coming up to Chicago and buying homes up here with the real estate taxes as crazy as it is.
Really?
Right? Yeah. I mean, why would you do it when you've got a $300,000 home up here with $8,000 to $12,000 of real estate taxes when you could go to Georgia or Florida or Tennessee and get the same home for 80% less in real estate taxes? So cash flow is a lot better when the real estate taxes are a lot lower. That's a whole nother show,
okay,
a whole nother topic. We need at least an hour and a half with the clowns that are running Cook County and Chicago here. But what that person, right? Again, it all depends. Okay, it all depends. But that delayed financing, it's a huge benefit because a lot of the parents or relatives have the money that they either rip out a home equity line of credit against their home that's probably paid for, and then pay $300,000, $400,000 for a home, and then the borrowers secure a mortgage and pay their parents back or pay their family back. You just got to follow the flow of the money and document it came out of an account, it went to go buy this place, and the money's going back into the account that it came out of. So it's a little bit of a paper trail, but it's not that big of a deal when you do it all the time. We do those loans all the time.
Okay.
Yeah.
Hey, let's take another break because we want to talk about Cars.com. Do you want to find a trustworthy dealer, a dealership that has reviews from shoppers like you? Look no further. Cars.com. None of the garbage, Dave. None of the fluff. It gives you everything you want right there on Cars.com. I love the website interface. It's easy to use. I could tell you exactly what your monthly payments is going to be, and I think that's important. A lot of people get a little scared by the sticker shock.
Count me as one of those.
Yeah.
Not everybody.
You have to start your car buying journey at Cars.com.
You do.
Yeah.
You do. So Cars.com offers the latest research, shopping tools, and dealership reviews to help every shopper find the perfect car. Shop by monthly payment or filter by features to find the cars that fit your budget and needs. Dave, I know you're a sunroof guy.
Yeah, but I think it's also really important to highlight that all these dealership reviews are made by people that have gone through the car buying process, and they're not just like reviews by the dealerships themselves, like state-controlled media, Mm-hmm. So you're getting fair and honest and accurate assessments of each dealership, and it'll just make the car buying process all the easier for you.
Yeah, so visit Cars.com and start exploring your next possibility today. This next one's pretty interesting. How do lenders look at borrowers with a history of gambling on their bank statements? What are some do's and don'ts?
Okay, so if gambling is your primary source of income, there are bank statement loans. Okay, where we're doing them for self-employed individuals. So a gambler, if that's your primary source of income, we need 12 months worth of bank statements, and we take those 12 months. And we basically average all the deposits, not transfers, deposits, and divide by 12, that's your income. We don't take the losses, we take the deposits. Now, if that gambler, if that's their side business, and I'm going to use $120,000 again because it's easy to do the math, and they're making $120,000, We just use the $10,000 a month and count that as their monthly income. Now, if you're taking a loss on your taxes due to your gambling loss, then we'll have to deduct that loss from your gross income of your W-2. Again, it depends. I hate giving that answer because it's such an attorney answer.
Yeah.
But it's tough to give you a specific question without knowing that question. It's a great question. I don't know if that's that borrower's primary source of income.
So what if it's not your primary source of income?
And they have a W-2 job?
Yeah.
We just go off the W-2 job. Now, if they're reporting those losses on their tax returns, then we got to deduct that from their W-2 income.
Okay.
And then if they have a plus from their gambling, we just add it to their W-2 income.
So do you see that they're whacking people, though, for this?
Don't get many gamblers. It's a gregreat question.
Because that seems to be a narrative that, like, oh, they're not clearing people because they're seeing.
No. Again, it depends. Here, I had a buddy of mine, fraternity brother of mine. He worked at an insurance company, made $300,000 a year. Okay, he gave me his bank statements because I had to source his bank statement because he was buying a home. Okay, so he sent me all his bank statements and literally Rivers. Okay, you saw Rivers come out, Rivers Casino here in Des Plaines. Okay, so Rivers, he ripped out $5-10,000 out of something. Right, he was an ATM machine because he needed cash. He went there and he paid it all back. Right, and the underwriter's like, the person that's grading your loan for approval is like, what are all these Rivers? So I had to go back to my buddy. I'm like, hey, I need a letter of explanation about what this. He's like, what date was that? So he's like, oh, I had a great night that night. And he wrote a letter of explanation, typed it out, signed it. I took it out. I wound up winning $30,000. I was late. I didn't want to put it back in the ATM machine. I went to the bank the next day, put the money back, and we were able to show the money came out at Rivers. Next day he went back, put the $10,000 back, and he kept the $10,000 in a safe, and that's what he did, and he used that for future opportunities at the casino.
Okay, so as long as you kind of have
we got to close the loop. Yeah. Just got to close the loop. It's got to make sense. You can't just pull, another huge mistake, mattress money. Okay, I'm pulling mattress money. I'm pulling cash out of my safe. Okay, I had a guy I'm like, what are you going to use for the down payment? That's what every lender's going to ask you. I've got Cougarans. I'm like, fantastic. I'm thinking he's got a gold fund, right? He's got a fund, a Cougaran fund. I'm like, great. Where are the Cougarans? He's like, they're in the safe in my house. I'm like, okay. I'm thinking, okay, maybe we could document that he bought the Cougaran someplace that my uncle gave me 7 years ago. I'm like, well, I got these fucking Cougarans in a safe from 7 years. I can't source.
What the hell's a Cougaran?
It's gold. Right, it's a gold bar. It's I think it's South American, if I'm not. Yeah, no, it's like it's these little gold bars. I was like, well, that's great. I'm glad you got Cougarans. Yeah. Okay, but I can't source. I could source the value of the Cougarans because I can look up what gold's worth and you tell me what the value, but I can't pull it out of somebody's safe. So if you've got, here's another tip: you can't just drop in money out of the sky. Okay, it's either got to be in your account for 60 days, it's called seasoning, or you got to get a gift from a family member if you don't want to source the gift, and they've got to bring the money into the transaction. So again, there's ways around this, but you need some proper planning so you don't mess it up. If you think, oh, you know what, I got $100,000 in my safe in my house, I'm going to use that for the down payment. Sounds great, but we can't bring in cash from a safe without showing where it came from. There's ways to bring it into the transaction, but you have to do it in the proper way.
Okay.
So, and there's steps. So I'm not saying you can't use it. You can't just drop it in at the last minute. We got to document where it came from, and there's ways to do that.
Yeah, I think I had to do that. I was one of those weird people who'd just stock cash away.
Yeah, right. And you got a gift from a family member, and it all worked out.
Yeah, exactly.
Right. Because you didn't know any better.
No, I had no idea.
I
had no idea.
You are Barstool Eddie. Your job is to create content and entertain people and give updates at halftime and after Bears losses, right? As miserable as you are, right? And that's your job. Your job isn't to figure out how I'm going to finance my home, right? Mm-hmm. Your job is to do what you do, right? Create content and crush it here. I'm the Barstool Eddie of the mortgage industry. I'm the Chief and the White Sox Dave of the mortgage industry.
Yeah.
That's what I do, right? I don't do this. You guys do this. This is your area of expertise. I stay in my lane, right? Mm-hmm. And that's what I do. So if you've got a question, don't assume anything, right? 99% of things typically could be worked out. if we have enough time to plan it properly.
Okay.
That's what it's all about.
Next one here. I bought a house in 2020 at a 3.25% interest rate. It has appreciated in value, and I have probably 100 to 120K in equity now.
Mm-hmm.
Since then, I have had a kid and already feel like we are outgrowing that house. I feel like I would be an idiot for getting out of this loan at that rate, though. Any tips on what to do next?
Okay. Again, is that person and his wife ready to become a landlord? All right. If they are, great. So what you do is now they got $100,000 worth of equity. They probably need some of that for the downstroke on your new place. So what do? I'll introduce them to a bank, Kane County Teachers Credit Union. We'll rip out a home equity line of credit out of their current home. They'll take that portion of the home equity line of credit, put it down on their new home. So now what they have to factor is, number one, do they want the Michigas of being a landlord? Wife, kid, new house. Do you want to be a landlord? Yes, you got a great rate. Do you want to be a landlord? Then you got to figure out with the current principal and interest payment, with the new insurance payment, because it's going to go up because it's going to be an investment property, and the new tax payment because it's going to go up because it's going to be an investment property. Can you make enough money to cover your nut, put a little away in reserves for the broken furnace, for the broken pipes, for the roof that's going to need to be done in 10, 15 years, for the HVAC unit that might go out? There's $7,500, right? For all the stuff that could possibly go wrong, as you know, as a homeowner, that you need to have dough as a backup. Do you want to go through that? If not, I can introduce them to a realtor to help them sell the house, locate a new house, and move on. So it all depends.
How hard is it to do the reverse? Like, hey, I have my house. I want to buy a rental property. But you don't have that proof, though, of...
Well, you got to have enough income in order to, and enough of a down payment to buy an investment property, and then bring in a renter. If you have a renter, we could count that rental income against the cost of the investment that you're about ready to take on. So again, proper planning, you got to get ahead of it, right? Hey, Dave, I'm thinking about buying a $200,000 condo as an investment property. Great. How much you got for a down payment? 3%. Well, that's great. I'm glad you need a little more than that, right? You need another 17% in order to pull this thing off. 25% would be better. You got closing costs. And do you have a renter? No, I don't have a renter. Well, it might be a good idea to check around to see if you could get a renter before you buy that place, so you know you're not going to be 1 month or 2 months or 3 months having an empty condo or an empty house with all the expenses on top of that.
Next one here. My name is Scott. The question is, I already have a first-time home, but before that I had a condo, and I wasn't able and never really was able to capitalize on the first-time home buyers. Sorry, I'm just transcribed. This was a voicemail. Financially, assistance with what they said is a federal issue that would ever be considered to be adjusted for those. And let's just say, does this make any sense right now?
Kind of, sort of, keep going.
It's transcribed, like I said.
I'm trying to flow chart it here.
Yeah. And let's just say they're never going to be going into a home or can't afford a home, but might think a condo or an apartment suits them better. Why isn't first-time home buyers available in such case?
Okay, so again, a first-time home buyer is classified as somebody who hasn't owned a home in the past 36 months. So if Scott has owned a home in the past 36 months, Scott can't take advantage of the first-time home buyer. Now, if Scott is getting married or has a partner, right, or is buying it with somebody else, and they're a first-time home buyer, then that property, even though Scott's going to be a co-borrower on that loan, gets the benefits of the first-time home buyer opportunities, which are extremely discounted rates. So the couple in Missouri I talked about earlier, right? We got them in the high sixes. If they weren't first-time home buyers, they would have been in the low sevens. So we saved them probably a half a point in the interest rate because they're first-time home buyers. So if Scott is on the title of a home, which classified as a first-time, it means you own a home. If Scott's had ownership of a home in the past 3 years, he wouldn't get any benefit of that. But if Scott's buying it with somebody else, then that person is a first-time home buyer, and that would qualify as a first-time home buyer discount.
Does it reset after 3 years then?
3 years. If you haven't owned a home in 36 months. So if Scott sells all of his properties, lives with somebody, and somebody else is on the home for 3 years, and he hasn't owned a home in 36 months, boom, you're now considered a first-time home buyer. I know it's crazy, but that's the government definition of a first-time home buyer.
Trying to regulate things like that?
Well, yeah, they're trying to incentivize people. It really came into vogue in 2008 when everything was collapsing and real estate was on fire and there was blood in the street and we had over 100 months worth of inventory. So Bush came out with something, Obama incentivized it, juiced a little bit. It was $8,000 for first-time home buyers, and then you had to pay it back if you moved, I think, in the first 5 years. All of a sudden you saw inventory, if you were a first-time home buyer, you saw inventory shrink because all the first-time home buyers came running. The toughest part about buying a home is the down payment and the closing costs, as you know. Okay, so that $8,000 at the time in 2008 offset a lot of those costs. I know Kamala Harris was promoting $25,000. She lost, and I don't think Trump's going to do it. But that $25,000, I don't know where would it come from, but that $25,000 would have helped a lot of first-time home buyers. And this isn't a political statement. Don't fire on me for that. I'm just making a point, right? Back in 2008, that really helped suck up a lot of inventory when we needed that inventory, when there was a ton of overhang in the inventory. Now we're back nationally to about, 3 to 6 months worth of inventory, which is normal. Mm-hmm. Southern states are starting to see elevated levels of inventory, not so much up here in Chicago.
So not to get political, like you said, but do you foresee these interest rates going down at all in 2025?
I hope so. Here, the biggest thing that your listeners should be and your viewers should be paying attention to is the jobs market. When you start seeing jobs fall off, I can tell you right now, 2 out of 5 credit card holders are maxed out on their credit cards. I think 70% of Americans don't have $500 in the bank account to take care of a necessary emergency. I can also tell you that the credit card debt is $1.17 trillion, the highest it's ever been. So when you factor in highest credit card debt levels that we've ever been in as a country, congratulations to the U.S. consumer for hitting a new record. 2 out of 5 Americans have maxed out on credit cards, and you have you've got $500. You've got, I think, 60 or 70% of Americans don't have $500 in their bank account for an emergency. There's a reckoning coming, okay? And when that reckoning comes, when people stop spending money on shit they don't need with money they don't have, I've been saying this for the past 2 years. That's when we'll start seeing rates come down, because then the economy will slow down. And they'll have to juice the rates, decrease the rates in order to get the economy going back again. These tariffs, again, not a political statement, but when Trump came in, the market was a little freaked out. They like Scott Bessent, his Treasury Secretary pick, so that was a good move. The Wall Street knows this guy, and they respect this guy, so that was a good move for interest rates. It kind of dropped them a little bit, and hopefully these tariffs are just a threat to the other countries where he doesn't do it, because that's going to increase the cost of goods, and any increase of cost in goods is going to increase inflation, and any increase in inflation is going to drive up interest rates for homes. So we'll see. I'll let you know in February after President-elect Trump is sworn into office. So we'll see what happens. I hope we see a decrease in rates, and that we could come back to you again and say, hey, we're going to take you from where you're at, drop you another half to 3/4 of a point, get you in the low 6s, and save you, another $200-300 and really make it feel good.
Me too, David.
I know.
Me too.
I know.
My final question here.
Yeah.
That was all the listener questions, and we could kind of wrap up here before we get a few more things out. One thing that I never understood, and you're like, hey, I could explain this to you, but it's a bunch of mortgage lender shit that you don't need to be concerned about, but this is the way it is I was prepared to throw down a down payment that was higher than what you ended up making me do.
Yeah.
Or higher than not making me, what I went with.
What I recommended.
Yes, exactly.
You want to talk? Can I have your permission to talk?
Go for it.
Okay. So when you came, and again, I always ask that because all the information is private. So you came to me and said, hey, I want to put 10% down. I said, no, you don't. You're like, why? I'm like, 'cause you got great credit. You got good income. You're fine. You told me that the house doesn't have a garage. Okay. And the big thing here in Chicago is a garage.
It was a shitty garage.
Well, it was a shitty garage, but you wanted to build a Taj Mahal, right?
Yeah.
You wanted to build a great garage, which you did, right? It's a beautiful garage. We just refinanced it. I walked through it. It's beautiful. That costs money. That takes liquidity. That takes resources. Mm-hmm. So I'm like, here's what we're going to do. Here's what I recommend. Put down 3%. And you're like, why? I'm like, because you can. Okay. Yeah, it's going to increase your payment maybe $70 a month. It was no big deal. Use that money to invest in your garage. You got a beautiful garage. That garage substantially increased the value of your home. When we did the appraisal, your value shot up. So I said, wait until we get the appraisal on the refinance and bring in whatever difference we need at that time to get you out of PMI, which we did. And it was only a couple of grand instead of tens of thousands of dollars. So I call it monetary masturbation. Okay. We're just playing with numbers. That's all it is. It's a monthly payment. And where can you use that money most effectively? For you, it was taking that money and investing it in your garage. For somebody else who might have 10% down or 20% down, but they've got $40,000 worth of credit card debt over here, and that $40,000 is costing them, I don't know, $1,200 a month, and that $1,200 a month in a mortgage payment is the equivalent of $150,000, $160,000 mortgage payment. So I'm like, hey, why don't we take your down payment that you think, because you hate PMI, take that money, apply it to your debt, eliminate that debt. What happens? Payment's gone. What happens? You qualify for a higher mortgage. You qualify for more of a loan because that payment's gone. Then what happens? Your credit scores shoot up. Enables me, the lender, to get you a lower rate, lower PMI because your credit score's higher. So when it came down to structuring your loan, and again, it's transaction specific. It's monetary masturbation, not trying to be funny, not trying to be crude. I'm just telling you, we're playing with numbers. That's all it is. And each person, each borrower has a different set of variables in order to put into play that we need to get your loan done. And in your loan, I'm like, dude, keep the dough, put it into a garage. When we refinance you in the future, when rates drop, that's when you bring in the extra capital if we need to. And we only needed, it was only a couple of grand to get you out of PMI. And it was better spent that way. And you got to use that money to build your garage instead of finance your garage, which is what it's all about.
Yeah. And I think coming to the end here, like I said, covered a lot of good stuff, and people are listening and you're like, hey, let's backtrack and let's start from the beginning. I don't know what the fuck PMI means. We could do that another time too.
Sure.
Or you do it, you got a show on WGN and whatnot.
Yeah, Saturdays.
Is there, let us know, basically is what I'm saying. But that's kind of like I guess more of a sped up tutorial at the,
what's PMI? Yeah. Private mortgage insurance. If you don't put down 20% on your loan, on a conventional loan, Fannie Mae, Freddie Mac, it's an insurance policy for the lender that you don't default on your loan. FHA loans, if you're going to have PMI in your loan for the full 30 years of the loan. If you put down less than 10% when you buy, you're going to have it on a 30-year fixed loan. You're going to have it for 16 years. If you put down more than 10% in 13 years, if you have a 15-year fixed loan. I know I'm going into how to make the sausage, but we could go into it more. And if your listeners want me to come back, I'm 25 miles away. I'd love to have the opportunity. And I'll write something up that you could post with this to answer the questions in more detail.
Oh, that's a good point. I'm happy you brought that up. FHA versus?
FHA, Federal Housing Administration.
Versus, what's the other one? Conventional
loans, Fannie Mae, Freddie Mac. There's nothing wrong with FHA loans. FHA loans are great loans.
Explain what an FHA loan is.
FHA loan is Federal Housing Administration Authority. Federal Housing, I get the A screwed up. They offer loans. It was created coming out of the Depression to help blue collar men and women who finally got jobs to use their money to own property, to buy property, right? So it's a great loan. It helps for those coming out of bankruptcy and have credit challenges, and they'll go to cash out to 80% if you're credit challenged. So there are a lot of different benefits. Each loan is differently set up specific for each different lender, right? There's VA loans too for the men and women who have earned the right to, who've been honorably discharged and have served our country or who are currently serving our country. They could get VA loans. Then you've got rural loans, USRDA loans that are for your listeners and viewers that live out in rural areas. So there's a bunch of different types of loans. And you've got portfolio lenders who do the wacky stuff, off the wall stuff that your traditional Fannie Mae, Freddie Mac, or FHA and VA or USRDA won't do. So there's a lot of different variables out there. Just love the opportunity to talk with your viewers to see what's best for them and help them out, either today or to buy in the future.
All right. Anything we didn't get to here, Dave, that you want to end on? And obviously tell people where they could find you.
Yeah, it's I've got a show on WGN. We'll just plug that real quick. It's AM 720. You can listen. It's Saturdays 10 until 1 on AM 720 WGN. You can listen online at WGNDavid.com. Go to our website, the number 5, the number 6, David.com. You could give us a call, 855-56-DAVID, which is 855-563-2843. We get back to everybody within 24 hours, if not sooner, and appreciate the opportunity you having me on.
Of course. Thanks for coming. I'm happy that you did the numbers out. I think there's a lot of people now that don't remember you put the letters in.
855-563-2843 is our phone number. Toll free, 24 hours a day.
Sweet. Appreciate you, Dave.
Thanks, bud.
All right, everyone. Thanks for listening. Thanks for watching. That's it for today. We'll see you guys next time.